Last week I made $78,000 on a single trade, not because I knew what the jobs report would be, but I understood how Wall Street will react. And that's the difference between watching the market and understanding the market. Today we're going to break down exactly how that trade happened. Then we're going to talk about inflation numbers that may move the market this week. We're also going to talk about inflation numbers that may move the market this week. I want to explain some terms to you. You may have heard bullish, bearish, hotter, cooler. All of those things have meaning when it comes to the stock market. We're also going to look at the largest IPO in history, SpaceX, and we're going to answer questions from the heavy returns community. This is episode 3 of the Heavy Return Show. 1 discipline, 2 scoreboards. Tap in. This show is built for investors and traders who are trying to build wealth through discipline. Here's what we have today. First is SpaceX. Now this is the one that everybody's been looking forward to. As you may know, on June 12th, SpaceX will officially be on the New York Stock Exchange. Then we're going to break down the jobs report from last week that ended up netting me $78,000 in one trade. After that, we got CPI, PPI, bullish, bearish, hotter, and colder, and how to actually understand the language that Wall Street uses every day. Then we'll compare VOO and QQQ inside of your Roth account. And finally, we'll answer some questions from the Heavy Returns Discord community. If you're getting value from these episodes, hit the subscribe button. Let's get to work. All right, so let's go ahead and start with the biggest story of the week, SpaceX. Shares are expected to begin trading around $135 per share. At that price, the company would be valued at $1.77 trillion. Do you understand how massive that is? No, really, I want y'all to think about that for a second. Private company becoming one of the most valuable companies in the world overnight. But here's where most investors stop thinking. They hear the valuation, they hear the hype, and they hear the ticker, and they ask themselves, should I buy it? But that's the wrong question. The first question should be, how much of the company is actually available for trading? Because liquidity matters. When a company goes public, insiders cannot sell immediately. That includes employees, early investors, anybody on the corporate board that may own shares. Those restrictions exist because if everybody dumped at once, then the stock would actually get crushed. This is what Wall Street calls a lockup period. And understanding lockups is critical because great companies don't always become great investments. That's why you guys have to evaluate SpaceX before you invest your money into it. So as I'm looking at SpaceX, I'm asking myself 3 questions. Who can sell? When can they sell? How many shares are actually available for trade? And y'all know when shares hit the market, that price will change because after the lockup period, more shares will hit the market. And when that happens, supply changes, and the supply changes, so does price. But here's the real question. Would you buy SpaceX for $135 per share? Most investors will start looking at the company, but for me, I start looking at expectations because great companies can still become terrible investments if the expectations are way too high. At a nearly $2 trillion valuation, how much future success is actually priced in already? That's the question that investors actually need to ask themselves. The question isn't whether SpaceX is an awesome company. We already know that it is. The true question is whether or not the price makes sense. As for me, I've already requested to purchase my shares on day 1 of the IPO, but SpaceX isn't a trade for me at this particular point. It's a long-term investment. And as you guys know, I like to invest at least 5 to 10 years down the road. So with that in mind, when I do purchase my SpaceX shares, I'm going to hold them for the long term. I actually want you guys to write down in the comments what you have planned for SpaceX. All right, let's move on. I actually want to talk to you guys about the 4 major earnings that I'm looking at for this week. We have Lennar, Oracle, Chewy, and Adobe. Let's start with Lennar. Lennar is one of the largest home builders in America. Looking at this stock is one of the best ways to measure the overall health of the housing market. For Lennar's earnings, we'll actually look at new orders and average sales price. We'll look at the margins as well by mortgage buydowns, but the rates is what tells the actual story. A weak report actually tells us that the consumer is tapped out, and you guys know a weak housing market means a weak economy. Now, Lennar drops earnings on this Thursday, June 11th after the close. If you guys want to listen to the earnings call, let me know and I'll drop the link for you. Next up is Oracle. This may be one of the most important AI infrastructure stories in the market. Oracle continues to spend aggressively to keep up with AI demand. But the company ain't just selling software anymore. It's building the digital infrastructure to power artificial intelligence. Now, the cloud revenues for Oracle was up 46 to 50%, but the free cash flow is actually negative, and we need to be aware of the backlog. The backlog is simply accounts receivable, the money that's already signed but actually not collected. Now, that's the AI demand signal for this company. If the backlog has actually climbed, then negative free cash flow is not bad. So we need to be aware of the backlog when we're listening to this week's earnings call. Oracle drops earnings June 10th, this Wednesday after the close. Now, next up is Chewy. They drop earnings on the same day as Oracle. However, these earnings will come before the markets opens. But the difference is their earnings will actually drop before the market opens on Wednesday. Now, right now, their sales are flat, but their margins are climbing, and they're actually near a 52-week low. A 52-week low means that this is the lowest price that a stock has traded at for the previous 52 weeks, or a year. With the stock at its 52-week low, sometimes that could mean that it's cheap for a reason, but other times there may be the opportunity. The best way to tell the difference is to dive into financial statements and see what the numbers actually say. If you guys need a breakdown on how to do that, just go to episode 1 or 2 and I'll show you exactly how to break down a company. We want to watch their active customers and their net margin. What that means is we want to see more profit from the same exact consumers. Now, some people may consider Chewy to be a boring business, but they have some loyal customers. This may be one that we want to watch closely. Now, finally, we have Adobe. Adobe drops earnings on Thursday, June 11th after the close. Now, when it comes to Adobe, Wall Street has a lot of fears that AI will actually disrupt its stock, but Adobe's been smart enough to integrate AI into its products. So when earnings drop this week for Adobe, we need to focus on new subscriptions and also new AI features. I will be dropping full breakdowns on Lennar, Oracle, Chewy, and also Adobe, and even SpaceX this week. So if you haven't subscribed to this channel yet, now's the time. So let's jump from earnings and jump into the $78,000 trade I took last week. So last week on episode 2, I told you guys that I was looking at the jobs report. Wall Street expected about 80,000 jobs to be added on the jobs report, but the numbers came back at twice that amount. 172,000 jobs were added for the month of May. Now, if you're new to investing, that sounds like good news. More people working, more people making money. That sounds like a better economy. But Wall Street doesn't see it like that. A stronger labor market means that the Federal Reserve will actually have less pressure to cut rates, and higher interest rates are normally bad for stocks. So what happened? The market ended up selling off. The S&P actually dropped 2.5% on Friday. So I positioned myself with SPY puts. SPY is an S&P 500 ETF. When we purchase put options, we're actually shorting the stock, or in other words, actually profit as the market goes down. So even though the market went down, I still was making money because I bought a put option. So I bought 1,000 contracts. Each of those contracts cost me $101. Y'all see that? 1.01. That's $101 because remember, we take the contract price, we multiply it times 100, and that gives us the premium for that particular contract. I had 1,000 contracts. Each of those contracts went from $101 to $179. You multiply that by 1,000 contracts and you get my profit, which was $78,000. Here's the lesson. Good news ain't always good news and bad news ain't always bad news. The market doesn't react to headlines. The market reacts to expectations. If you know how to position yourself accordingly, then you could profit either way. You guys need to understand the differences between call options and put options. If you want to learn more, comment down below and I'll be your guide. I'm so glad that we touched on the jobs report last week because this week we have even more economic data that comes out. The purpose of this segment is to show you guys how to position yourself accordingly. All right, so this week we have CPI versus PPI, Consumer Price Index versus Producer Price Index. So CPI, PPI, bullish, bearish, hotter, cooler. If you ever watch CNBC, you might have heard these terms, but nobody ever explained them to you. That's the purpose of this segment. I'm gonna walk you through it. Let's first start with CPI, okay? So CPI is the Consumer Price Index. That is what we pay as consumers, what everyday normal people pay. This is what we pay at the register for gas, groceries, rent, everyday expenses. That's CPI, the Consumer Price Index. I want you guys to look at it like it's a receipt. Then we have PPI, or the Producer Price Index. This is what businesses pay to make the stuff. So think of it like the kitchen. This measures what businesses pay before these products actually reach consumers. Raw materials, manufacturing costs, transportation costs, and even labor costs. Kitchen usually gets more expensive before the receipt. These businesses will pass these costs off to their consumers. So it's actually important as investors for us to pay attention to both. Now let's define two more words, hotter and cooler. When the news says that inflation data has came in cooler than expected, well, that's actually a good sign for stocks. Cooler means that prices increased less than expected. Notice that I didn't say that prices fell, they came in less than expected. That's a huge difference. Now let's flip it. If inflation comes in hotter than expected, then that's bad for stocks. Hotter means that prices rose faster than expected, which brings us to our next two words, bullish and bearish. Bullish means that the stock market is going up, and bearish simply means that the stock market is going down. That's all there is to it. Now let's connect everything together. If CPI and PPI comes in cooler than expected, then that's a bullish sign for the market. If CPI and PPI comes in hotter than expected, then that's a bearish sign for the market. And if one comes in hotter and one comes in cooler, then expect volatility because the market won't have a clear message. Let me give you a real example. Last week's jobs report was actually good news. More jobs, strong labor market, healthy economy. But the market dropped anyway because traders believe strong jobs data reduce the chances of future rate cuts. That's exactly why y'all can't look at news as good or bad. Don't trade the number, trade the reaction because the reaction is where the money gets made. All right, so now we have the meal plan. This might be my favorite segment. All right, so this week's focus is VOO versus QQQ. Both of these are ETFs. VOO is an S&P 500 ETF, all right? right? Think of it as defense. It's diversification. It's the top 500 companies in America. There's 500 holdings, 500 different stocks that this ETF holds. So the risk is very minimal. In the past 10 years, VOO averages almost 16% per year. And next we have QQQ. This is also an ETF. The difference is this one is more so offense. QQQ is the NASDAQ, are mostly tech stocks and growth stocks in the economy. For the past 10 years, QQQ has averaged about 21% annually. So with VOO, they has an expense ratio of 0.03% versus QQQ is a little bit more expensive, and that's 0.2% in comparison to things like your 401k or something like that. Both of these ETFs are considered to have low expense ratios. The whole purpose of the meal plan is for you guys to take boring steps to build wealth. And then I have this illustration down here. It's assuming that you're putting about $500 a month in some kind of account. After 10 years with 10%, you'll be at about 103,000. 20 years, you'll be at 380,000. And then 30 years, you'll be at a little bit over $1 million. Again, these are assuming 10%. This illustration doesn't even assume the rates that you get with VOO or QQQ. Y'all may want to check these out. See, the biggest mistake is not choosing between VOO and QQQ. The biggest mistake is not funding your retirement at all. Because if you have a Roth IRA, then your money can grow tax-free. The biggest mistake is never funding your Roth account at all. In your Roth IRA, that money grows tax-free. And over decades, that can mean hundreds of thousands or even millions that go to your pocket instead of the IRS. Before you start hunting for the next stock, focus on building that Roth account. Now, this ain't tax advice, y'all. This is just a little education. Spot Me is where we focus on questions from the Discord community. First up, we have a question from Don, a very prominent member of our community. He asked me, should I work out in the morning or hit the charts first? So my answer was health and wealth are the same habit. Train the body, train the account. I win in the morning, so my head is right when the bell rings. So pretty much I explained to him that I always work out first thing in the morning to clear my mind. You want to clear mind when you're in front of those charts. I'm sure that it's possible to do it the other way. I just find that it's a better flow. So next up, we have a question from Spiffy Trade. I made my first trade. I'm not sure I did it right. My answer was you already beat the 90% who only watch. First rep is honestly the hardest. Win or lose, you have to write down your why, your entry, your reason, and also your exit every single time. The journal is the lesson, not the trade. I want y'all to write that down. The journal is the lesson, not the trade. If you're writing down every single trade, why you won, why you lost, that's only going to build up your mental muscle so that you can attack this market even harder. You guys need to be in the habit of understanding why a trade was won and why a trade was lost so that you could do more of the winning and less of the losing. Get you a trade journal. If you need guidance on a trading journal, just comment down below and I got you. We have our final set, which is just a recap for this week. Today we cover SpaceX and why liquidity matters and what I plan on doing with SpaceX. We talked about earnings for Lennar, Oracle, Chewy, and Adobe. We broke down the jobs report that led to me making $78,000 in one trade. I explained to y'all CPI, PPI, bullish, bearish, hotter, and cooler. We also compare VOO and QQQ inside of a Roth IRA. I was once in you guys' shoes before. I understand that a lot of these terms are complex. There are some things that sound like a language that we don't even understand. Bearish, bullish, CPI, PPI. These are all terms that you will get to learn. You just have to remain dedicated to the game. Take one day at a time. Get you a journal. Get you a pad and pen. Write down the terms that you don't understand. Go and research them. You only get out this market what you put into it. If you ain't doing the work, you ain't gonna make the money. You need to learn before you earn. If you guys got value from this week's episode, y'all need to tap in. Go ahead and subscribe to my channel. If y'all want to join our community, which is free, all you have to do is go to heavyreturns.com/discord and the link is there. And finally, if you go to heavyreturns.com, you'll get free access to my newsletter. If you're serious about building wealth through discipline, then you're in the right place. Analyze, execute, profit. I'll see y'all next week. Peace.